Hey, Kyle here with WinTheHouseYouLove.com. You might have heard of a conventional loan and are wondering if it's the right loan for you. And choosing a loan can be one of the most overwhelming parts of looking to buy a house. So in this video, I'm going to cover everything you need to know about conventional loans in 2024, if it's the right loan for you, and if you qualify, and all of the details. We'll even go through examples, so I'll show you numbers. Everything you want to know about conventional loans is right here. You may even know more than some loan officers by the end of this video. So conventional loans are mainly thought of the best loan for home buyers who have higher credit scores. Usually in the range of 680 and above tends to be best for conventional loans. And they often are seen as the best loan in really competitive markets. Sellers tend to prefer home buyers who have conventional loans compared to something like an FHA, VA, or USDA loan because they think that they're better qualified buyers, and the appraisals are a little bit easier compared to other different types of loans. Also with conventional loans, there's this real big myth that you need 20% down to get a conventional loan, and you simply do not need 20% down. You can get conventional with all the way down to a 3% down payment. And in this video, I'll show you how you can also do a 1% down conventional loan and get a 2% grant as well. Now, conventional loans are for primary residences, meaning you're going to live in the home as your primary home. For secondary homes like a vacation home, and also for investment homes. Now, here are the down payment requirements for conventional loans. If you're looking at a one-unit home and you're a first-time home buyer, then you can get a down payment of 3%. Again, it's not the 20% down that people think. Okay, now, if you have less than 20% down, it's going to require what's called PMI. It's private mortgage insurance, and it's basically a monthly payment that you pay to the lender because the loan is a little bit riskier because you're not having that 20% down. You have less skin in the game, so to say. So if you're a first-time home buyer, if one person on the loan is a first-time home buyer, then you can get 3% down. Or if you're not a first-time home buyer, there are a subset of conventional loans called HomeReady and HomePossible. And you don't have to know this. You can just mention it to your loan officer and they can help you with this. And HomeReady and HomePossible is for home buyers who have income that is at or below 80% of the area median income, which I'll show you a tool that we can look that up later. Also, if you're looking at a one-unit home, so single family home, and you're getting a high balance loan, then it's going to be 5%. And I'll explain that when we get to the loan limits. Basically, if you go above the standard loan limits for conventional, then you need a high balance loan, and that does require 5%. If you're buying a second home, this is your second time purchasing a home, so you're not a first-time home buyer, then it will be 5% down. If you're getting a second home, so something like a vacation home, you're just going to require 10% down. If you're looking at a one-unit investment, then it's going to be 15% down. And if you're looking at a 2 to 4 unit investment home, it's going to be 25% down. Now, when you get to 20%, this is where the 20% down myth happens, is 20% on a conventional loan is where mortgage insurance is removed. So it depends on what type of or how big your loan is, but this could be anywhere from $60 to maybe even $300 or $400, again, depending on how big the loan is. And we'll talk a little bit more about mortgage insurance and how that falls off in the future. Now, what's really cool, this big change has happened recently with conventional loans in regards to house hacking and purchasing a multifamily with a low down payment. So what used to be the rule is that with both Fannie Mae and Freddie Mac, that it would require 15% down minimum to be able to purchase a 2-unit home. Now, a change has happened here in 2024 where Fannie Mae actually allows you to put 5% down on a 2-unit home and 5% down on a 3 to 4 unit home versus Freddie Mac requires 15% down and 20% down. Now, you may be asking, who in the world is Fannie Mae and Freddie Mac? These are the two main types of conventional loans. Most homebuyers don't even know which type of loan they're getting through their lender. But basically what happens is Fannie Mae and Freddie Mac set the rules for conventional loans. And what lenders do is they underwrite to those rules, and then they sell the loan to either Fannie Mae or Freddie Mac, who packages them up and puts them into a mortgage-backed security to then sell on the secondary market. So they make the rules here. And so if you're looking at trying to get a multifamily home, living in one unit for maybe a year and then renting it out, Fannie Mae now allows you to do that with only 5% down for a 2 to a 4 unit home. Now, you have to intend on occupying the home as your primary residence for at least 12 months if you are going to decide to rent that out in the future. Our team works in all 50 states. And so if you're overwhelmed by the process and you have questions about getting a loan, or you want to get started and see what your monthly payment is, what you get approved for, what you can do is go to winthehouseyoulove.com/lender, and you can go ahead and schedule a call with our team. We have mortgage advisors who work in all 50 states. We're not this big call center. We're just a local team who'd be happy to help you with a pre-qualification, again, in all 50 states. And if you're looking for a real estate agent as well, who can help you find the home you love and negotiate the best offer, you can go to winthehouseyoulove.com/agent to get an agent referral from me as well. So when you're getting a conventional loan, what's going to happen is you're going to submit your loan application to your loan officer. They're going to take a look at your documents, and they're actually going to take your loan application and put it through a software called AUS. So most homebuyers don't know about AUS, the automated underwriting system. And so what happens is AUS is the software that every lender has access to. It's the same exact software, okay? Every single lender is running your loan through the same exact software. And what they're doing is they're either running it through Fannie Mae's rules, or they're running it through Freddie Mac's rules. And if you're working with a good lender, they're running through both at the same time. Now, the reason that you want a lender who's going to run your application through both Fannie Mae and Freddie Mac at the same time is because it's going to give you the highest chance of getting your loan approved. Often what happens is a loan application may come through, and as loan officers, we'll go and put it through the system, and we may find that maybe Freddie Mac denied the mortgage application, but Fannie Mae approved the mortgage application, and so we'll do the conventional loan under Fannie Mae rules. Fannie Mae and Freddie Mac have very similar rules. Sometimes they're just small little differences, and it can really just be super tiny things where for some reason Freddie Mac may not want a certain loan. Maybe at that point in the year they're wanting higher credit scores than Fannie Mae, and so Fannie Mae might approve it, and vice versa. And so that's what we do is we take your loan and we run it through what's called dual AUS. So that way your loan application runs through both sets of rules, and we can get you the highest chance of approval versus lenders who just run your loan through one, and they might be missing out on the opportunity of you getting approved through the other. Now, HomeReady and HomePossible, I mentioned this a little bit earlier. So HomeReady and HomePossible are basically little subsets. They're classifications of conventional loans. So HomeReady here is a Fannie Mae product, and HomePossible is a Freddie Mac. And again, you don't have to know all the details of these different types of loan programs, but they're helpful to know about so you can bring them up to your loan officer to see if it's something you can qualify for. So HomeReady and HomePossible, very similar to each other. With them, you're going to have slightly lower rates than a standard conventional loan. You're also going to have slightly lower monthly mortgage insurance. And so HomeReady and HomePossible is a no-brainer if you're able to qualify for it. And the main way to qualify for HomeReady and HomePossible is that you have to have less than or equal to 80% of the area median income. So the way to look up if you're below 80% of the area median income is I have a link in the description to the Fannie Mae Area Median Income Lookup tool. So what you'll want to do is you'll want to zoom in to wherever you're looking to buy, and it's going to show you the area median income here. And right here, we can see 80% area median income right here for HomeReady, the HomeReady income limit, and that applies to HomePossible as well. So you want to scroll through this map and then take a look and see what the 80% area median income is. Now, if you find an area that maybe it's just too low for your income, and your income is higher than the limit, you can look at some surrounding areas to see if it might be better to purchase in those areas. Okay, so we covered the down payment. For most people, most first-time homebuyers who are watching this, you're going to be looking at 3% down most of the time. Now, what a lot of people forget about is closing costs. Often you hear real estate agents, they just talk about the down payment and never really talk about closing costs. And so homebuyers go into the process completely unprepared. And so closing costs are just a collection of the different costs associated with buying a home. Now, you're going to have closing costs no matter what lender you work with. And closing costs are not just what the lender charges. So, for instance, when you get a loan, you're going to need an appraisal. So an appraisal there on its own is going to cost anywhere from $500 to $700. You're also going to have title work done. So a title company is going to do a search on your home to make sure, one, there's no liens recorded against the home. That way you're not buying a home and immediately in debt that you owe somebody just because you bought the home. They're going to make sure that you have full legal ownership of the home. And so title costs money. Also, there's title insurance that's going to protect you from any future liens or errors in the recording of the deed. So you have that as well. Also, the county is going to charge you to record the deed and the mortgage. And in some states, you're going to have transfer taxes that are required to be paid by you. Again, this is only in certain states. Also, you have an escrow account. So for most people, the lender is going to pay your property taxes and homeowners insurance for you. So what they'll do is collect monthly payments from you for taxes and insurance, and then they'll make those annual or semi-annual payments on your behalf. But when you start the loan, that account needs to be padded with a little bit of money. So that is also part of the closing costs here. So it really is a collection of all of the services required to be able to get a home. Even if you're buying a home in cash, you likely are still going to run into closing costs. And keep in mind, closing costs are not just fees from the lender. So the lender can only control origination costs. So that's Section A and Section B of the loan estimate. When you take a look at that, they're not able to control all of these other fees in here. Okay, now something you need to watch out for is point stuffing. What's been going on a lot as interest rates have gone up is a lot of lenders are frankly getting a little bit desperate to get your business. And what they know is they know a lot of people who are looking to buy a home and to get a loan, the main thing they care about is the interest rate. We've been so conditioned to only look at the interest rate. But what often can happen is loan officers can actually charge you upfront cost for a lower interest rate. And this is what's called discount points. And the way a discount point works is basically, I like to think of it like upfront interest, where you're paying money up front and that lowers the interest rate. Now, that can be an effective strategy, but sometimes what's happening is we're seeing loan officers go ahead and charge sometimes $10,000, $20,000 in upfront closing costs and then show you a low rate. And then what often homebuyers do is they only look at the rate and not the costs. And then they say, wow, you have a much lower rate than everybody else. But it's because they're charging you all this money up front. So when you're looking at rates, be careful to look at the interest rate, but also the cost in discount points to get that interest rate. Okay, so if you're at this point, you're thinking, okay, I have the down payment and closing costs, and all of this already feels like it's going to be way more expensive than I can manage. I want to show you our grant finder tool. So we have 3 conventional grants, and the way that grants work is they don't require any repayment. So it's not a second loan, there's no additional lien, there's no repayment. A grant is something that's fully forgivable, there's 0 repayment, and you can sell or refinance at any time. And so I built a tool that helps you see if you qualify for one of our 3 grants up to $7,500 to reduce the amount of upfront costs in getting a conventional loan. So you can go to winthehouseyoulove.com/grant. So when you go to the grant finder, what you'll want to do is you'll answer a couple of quick questions on the site. And then from here, it's going to show you grants that match your profile. So you can see we have different types of grants and they're all going to give you different amounts. And of course, you're going to want to choose the one that has the highest grant amount. So in this case, it may be $7,500. And then from here, we even have a cost estimate comparison where you can see all of the upfront costs, estimated closing costs, and then see what the total cash to close, due at closing would be with a grant. So check out the grant finder if you're looking at these options. So make sure you look at the grant finder. We run the grant finder on every pre-qualification consultation that we do to make sure that if you have access to being able to get available money like this, that you're able to take advantage of it. Now, another great way to lower the amount of costs of getting a conventional loan is through getting a seller credit. And a seller credit is where when you look to purchase a home and you write an offer with your real estate agent, what you'll do is you'll request the seller to pay a percentage of the purchase price towards your closing costs. So for instance, you may ask them to pay 1% of the purchase price towards your closing costs. On a $400,000 home, that would be $4,000 that they would give you. Now, the maximum amount in seller concessions that you can ask depends on the down payment. So if you have less than a 10% down payment, the maximum seller concession is 3% of the purchase price. If you're doing 10 to 25% down payment, the max is 6% of the purchase price. And if you have a greater than 25% down payment, it's going to be 9% of the purchase price. Now, I have never seen a conventional loan with a up to 6 to 9% in seller concessions. Most of the time, people are maxing out around 3% because the more that you ask for in seller credits, the less likely the seller may want to accept your offer because that's money that's coming out of the seller's pocket. And they may do that in a market to make their home sell quicker and be more enticing to home buyers. But just know that the more that you ask in seller credits, it can make your offer less attractive to a seller. So for instance, if you were looking at buying a $425,000 home and you were putting 5% as a down payment, the maximum credit would be 3%. So you could request up to $12,750 in credit. Now, it's possible that your closing costs are not going to be that high, and so you wouldn't need to ask for that amount. Now, a big concern that people have had in 2024 with conventional loans is the recent NAR settlement, where really real estate commissions have come into question of who's going to pay for the real estate commissions, and if the buyer has to pay for it or the seller has to pay for it, how does that get factored into a loan? So when we talked about these seller concession requirements, remember there was a maximum limit. So 3%, for instance, might be the maximum if you're doing 5% down. So a lot of people were afraid that the buyer's agent commission might count towards that 3%. And Fannie Mae and Freddie Mac basically came in and said, commissions don't count in seller concessions. So basically it's business as usual. And so if this is something that's you don't understand, that's perfectly okay. This might be a little bit more tailored to real estate agents. But basically nothing changed in regards to buyer commissions or buyer's agent commissions when it comes to conventional loans. Now, there are rules on what type of money you can use to pay for your down payment and closing costs to buy a home. And so what lenders have to do is they have to verify the source of your funds. Where are you getting this money from? So the way that they do that primarily is through 2 months of bank statements to be able to verify the money that's coming in. And the main thing that underwriters are looking for is, one, do you have any recurring payments that could potentially be debts that aren't showing up on a credit report? And they also want to look for large deposits. And usually something that's a large deposit is something that's non-payroll and it's over 50% of your total monthly income. Okay, so your payroll income is perfectly fine. No one's going to question your payroll income. It's just if there's a random deposit for $10,000 in your bank account, the underwriter is going to say, okay, did that come from what's called an acceptable source? So acceptable sources are here on the left. So this is things like your income from a job or savings, your tax return. Everything there is perfectly acceptable. You can even get a gift from a family member to help you with your down or closing costs. If you're so fortunate to have a family member who can help you that way, you can use stocks and bonds. You can use a retirement account, loan, or withdrawal. So some people get into their IRA. Some people might do a 401k withdrawal or a loan. That's perfectly acceptable as well. Also, any documentable windfall. So things like inheritance, settlement. Sometimes if you have the sale of some property, maybe you sold a car for $10,000, as long as that's documentable, that's something that can be used. So you need some sort of receipt to show to be able to use that payment. Now, cryptocurrency is acceptable. I put a little asterisk here. It's only acceptable if it's liquidated into U.S. currency and in a U.S. institution. So as long as it's liquidated, turned into USD, then you can use that. But you can't directly pay with crypto on a conventional loan. Now, some non-acceptable sources are cash on hand. So if you have mattress money, you can't just use that. And often what I see people do is maybe they had some cash savings and then they go and deposit it all into their bank account. You can't just use cash. No lender, no underwriter is really going to accept accumulating cash and putting it into your bank account and allowing you to use that. If you have cash, the way to get around this is put it into your bank account now, and then we need to season that money. So it needs to be able to sit in your bank account for at least 2 months because, again, the underwriter is going to want to look at 2 months account statements. So anything that happened before that 2 months doesn't get looked at. It's just in that 2-month period. So any money that got deposited in before doesn't really matter to an underwriter. So things like personal loans, you can't use credit cards, and really any other unsourced money can't be used. You're going to have to season that money in your bank account, again, for at least 2 months before you can look at qualifying for a home loan. Now, for the credit score, the minimum for conventional loans is 620. Now, even though that's the minimum, it doesn't mean you're automatically going to be able to get approved if you have a 620. Sometimes people see this and think, I have a 620, I'm good to go. But 620 is really difficult to get approved for a conventional loan. It's, again, it is the minimum. And so everything else in your loan application has to be great. You need to have a low debt to income ratio, maybe a high down payment. it can be really tough to get approved with just a 620. 680 and above is going to be really the best place to be for a conventional loan. You really want to try to shoot for that 720 to 740 range, but 680 is where conventional starts to make more sense. 2-year credit history is going to be preferred by AUS. Sometimes you can get away with a shorter history, but 2 years is going to be the best there for credit history. Also, authorized user on a card can be helpful. So if you have a family member or someone that you know that can add you as an authorized user, that can help boost up your credit score, and that's perfectly acceptable on a conventional loan. Also, if you have no credit score, there are options to get a conventional loan with no credit score. And then we look at what's called alternate trade lines. So this would be something like we're verifying you've paid your rent on time for the past 12 months. We're looking at utility bills, maybe cell phone bills, insurance bills, things like that to build up kind of a credit profile. Again, this is no credit, not bad credit. You can't substitute a bad credit score for this option. This is only if you have no credit score whatsoever. Also, what you can do is add a non-occupant co-borrower for an approval. So sometimes what happens is you might be looking at getting a loan and maybe your credit score is in the mid-range, maybe you're at like a 640 and you try to get a loan and it can't get approved. And if you're in the fortunate situation where someone can be a co-borrower on the loan with you, that can help strengthen your credit profile and often nudge you into a loan approval. Now, if you do that, it does bring the minimum down payment from 3% up to 5%, but it can be an option if you have somebody who's willing to help you with that. And then often people ask what FICO models are used. These are the scores used by all lenders. So Experian uses FICO Score 2, Equifax uses FICO Score 5, and TransUnion uses FICO Score 4. Now let's run through an example of credit scores and how they work. So what's going to happen is the lender is going to take the median score, and then if you have two people on a loan, they're going to take the lowest of the median. Okay. So for instance, let's say we have a borrower. They have a 590 score, a 605, and a 648. Again, with Experian, TransUnion, and Equifax, because every person or most people have 3 credit scores. So what will happen is the lender will take the median score, so 605, to qualify for the loan. Now, let's say there's a co-borrower on the loan with them that has a 661, a 693, and another 693. Well, the median here would be a 693. So what will happen is between the two is the qualifying score on the loan will be a 605. Again, we took the median scores and then found the lowest between the median. That's what happens on most loans. Now, Fannie Mae does have this kind of weird rule that a lot of people don't know about, is that you can actually average to get above the 620 minimum, right? So in this situation, the person with the 605 or these people would not be able to qualify for a loan because they have lower than a 620. Fannie Mae, though, however, has this rule where what you can actually do is average those scores to be above the 620 range. So we would take 605 plus 693 divided by 2, and that gives 649, which again is above 620, and that would allow you to qualify for a conventional loan. So this is a trick that a lot of people aren't aware that can be done with conventional loans. Now, when we're talking about rates with conventional loans, you really have 2 main options. You can get a fixed rate loan or an adjustable rate mortgage. So the way a fixed rate mortgage works is that you're going to get an interest rate. Let's say it's 7%. And let's say you get a 30-year loan. So that would be fixed for 30 years. Your interest rate will never change, and your principal and interest payment will never change. It will be fixed for 30 years. Now, what could change is your homeowner's insurance, property taxes. That can change over time. But with a fixed rate loan, your interest rate never changes, and your principal and interest payment never changes. An adjustable rate mortgage is where the interest rate might be fixed for a certain period of years. It might be fixed for the first 5 years, but then after that, it may adjust every single year, depending on what's happening with the market. So it could go up in interest rate. It could also go down in interest rate. And so ARMs are something that I wouldn't recommend for most first-time homebuyers. ARMs are really going to be a better option for people who aren't planning on being on the home long-term, or they're willing to accept the risk of an ARM and potentially having a higher interest rate if market interest rates go up. Now, conventional rates are based on what's called loan level price adjustments. So I'm going to pull back the curtain here and show you a little bit of how this works on the back end. And so loan level price adjustments is just kind of this fancy term for saying your interest rate is based on things like your credit score, your down payment, and a couple other factors like if you're buying a condo or you're buying a multifamily or you're buying you're getting a high balance loan, that's going to be in there as well. So I have a whole chart that breaks this down. If you go to whenthehouseyoulove.com/rate hack, I show you a chart that looks similar to this. And what it can help you do is start to see what kind of down payment and credit score is going to give you the best interest rate. And so things in here, for example, if you were someone with a 780 credit score and you're saying, what kind of down payment do I need to get the best interest rate? This is showing you where the lowest opportunity is. So for instance, if you're saying, should I do 20% down versus 25% down? Well, 20% down would be a 0.188% higher interest rate on average than 25% down. So if you want to get in the weeds of looking through all those requirements, you can look at that chart there that can help you figure out what kind of down payment, what credit score to shoot for to get the best interest rate with a conventional loan. Now, you may be at this age and maybe you're feeling overwhelmed. Maybe you're feeling really confident. You've already learned a lot. It's perfectly okay to feel a little bit stressed at this point. As you're learning information, it's going to feel overwhelming in the beginning, but I promise it's going to click. And we're here to help. And so I want to help you put together a helpful team. And the best way to do that is to, number one, get pre-qualified. Our team works in all 50 states, and we'd be happy to help you answer any questions that you have, getting a pre-qualification letter so you can shop for homes, and then also helping you take a look at what your monthly payment would be along with your upfront costs. And so you can go to whenthehouseyoulove.com/lender. Again, we're not some big call center. What we do is we give you access to our calendar, so you schedule a time that works for you. And then we don't play phone tag. We're not going to harass you and call you all the time like a lot of lenders are going to do. You get to pick a time on the calendar. That way we can both meet and have a conversation about your best loan option. So all of our mortgage advisors have over 20 years of experience and would be happy to help you. Also, if you're looking to find a realtor after you get pre-qualified, the best way to do that is to go to whenthehouseyoulove.com/agent. And what you'll do is enter some details about what you're looking to do. And then our service can help match you with the best agent and even give you options for multiple agents if you're looking to interview different realtors. Now, one thing that gets talked about a lot with interest rates being higher where they're at this year is permanent buydowns and temporary buydowns. So let's explain what both of these mean. Permanent buydowns, I like to explain it as you pay the lender upfront interest to lower the rate. So think of it like a little bit like an investment. You're paying money upfront to help lower your monthly payment and your interest rate, and you want to be able to have a break-even period that makes sense for you. So for instance, when you're looking to get a loan, you actually can choose which interest rate you want. Most of the time, lenders will just show you what your rate would be with no cost or credits and no points. So they might say, hey, you're qualified for a 6.75%, but you can actually request a lower interest rate or a higher interest rate. Just know that they come with different costs or credits with it. So for instance, you could say, hey, I actually want to pay 1 point. And so your loan officer might say, okay, that could lower your interest rate to 6.5%. It would cost you $3,800 to do that. And then you can take a look at your monthly savings and interest and see what the break-even period is on that. And then on the opposite side, you could actually get a higher interest rate if you needed help with closing costs. And the lender could give you a credit back. So for instance, if we're looking at this example of a $400,000 purchase with 5% down, asking for 1 point in credit, again, it's going to increase your interest rate, but it could give you credit towards closing costs to help with that. And if you're wanting to compare different loan types and all these different point scenarios and different loan lengths and all the different types of situations you might find with loans, I built a software that allows you to compare loans side by side. It does all the math for you. If you go to whenthehouseyoulove.com/advisor, I have that loan comparison calculator. Okay, so another option is what's called a temporary buydown. So basically, it kind of does something similar to the permanent buydown, where the permanent buydown is lowering your interest rate over the entire life of the loan. A temporary buydown only buys down the interest rate for a certain period of time. It's temporary. So there's common types. There's a 3-2-1, a 2-1, and a 1-0. So it can be a little bit strange to get the hang of temporary buydowns, but Basically what happens is for, let's say, a 2-1 buy down, this is the most common type of buy down, is that in year 1, your interest rate is lowered by 2%. And in year 2, your interest rate is lowered by 1%. And then in year 3, your interest rate goes back to normal. So if your interest rate would be 7% on a loan and you wanted a 2-1 buy down, in year 1, the interest rate would effectively be 5%. In year 2, the interest rate would be 6%. And then in year 3 through 30, it would be 7%. Okay. So the way that this works is the seller or builder is going to give you credit for this money. And what happens is that money that they give you will be put into an account that's managed by your lender. And your lender will help you pay monthly in those first couple of years of the buy down to temporarily lower the monthly payment for the first couple of years. Okay. So the goal with a temporary buy down is that you would potentially be able to refinance in a short period of time, maybe in the first couple of years. And so mainly people get a temporary buy down in a market like this where interest rates are high. People are expecting interest rates are going to lower. And so a temporary buy down is a way to help alleviate the monthly payment until interest rates lower in the future. And again, nobody knows what's going to happen with interest rates in the future. So just be mindful of, if you are looking at a temporary buy down, plan on what the future payment is going to be when it's at the higher interest rate, not just what's happening on the front. Often what we're seeing with people is, we're seeing a lot of builders offering buy down incentives. And what can happen is homebuyers just get comfortable with the monthly payment, when it's 3% lower or it's 2% lower in the beginning. And then, of course, over time, that's going to increase to that final interest rate. So just be mindful of that. So if you want to explore more of how buy downs work, I have a calculator that does this. If you go to winthehouseyoulove.com/buydown. And so in here, you can enter details of what you're looking to do. And it will show you differences in your monthly payment. So year 1, what your payment would be, year 2, year 3, what the payment would be. It shows you that the payment in this scenario would lower by $549 per month in the beginning. In year 2, it's going to lower by $281, and then year 3 through 30, it would be fixed. And even shows you how much money you would need from the seller or the builder. So this is really helpful info to give to your real estate agent if you're looking to use one of these. And then also shows you that if you refinance, let's say within a year, you can actually get a refund back for the money that's remaining in that escrow account. Now, mortgage insurance. Mortgage insurance is the thing that everybody hates on loans. And conventional mortgage insurance is called PMI. It's private mortgage insurance. Now, there's no required upfront mortgage insurance that you have to pay. It's just monthly. And you're going to have private mortgage insurance if you put less than 20% down on a home. If you do 20% or more, you don't have any private mortgage insurance. But it's something to be mindful of if you're putting less than 20% down. Now, private mortgage insurance isn't as expensive as a lot of people think it is. Usually it's around 0.6% of the loan amount annually. So on a $300,000 loan, you're looking at around $150-ish per month in mortgage insurance on average. And again, yeah, of course, that's increasing your monthly payment, and nobody wants an increase in their monthly payment. But that could be better than saving. It might take you a lot longer to save for 20% down to remove that mortgage insurance. So it's giving you, you're really looking at the opportunity cost there with paying some monthly upfront. That way you can be able to get the home that you want rather than it taking maybe a year or two longer to save for 20% down to remove that mortgage insurance. Now, when you do get a home, let's say that you bought the home with 5% down. Once your equity gets to 20%, you can request that the lender removes mortgage insurance. At 22%, it's going to automatically fall off. So I would usually suggest to people to keep in mind when it's going to reach 20% equity. That way, you can request it off just a little bit earlier than when it automatically falls off. Now, if you have credit issues, conventional loans aren't the best options. Really, if you have some challenging credit or you've had some past credit issues, FHA tends to be the best. Conventional loans don't love credit issues. So things like late mortgage payments, you can't have any in the last 12 months. Charge-offs for a mortgage, you're going to have a waiting period of 4 years. Same thing with a deed in lieu of foreclosure, Chapter 7 and a Chapter 13. You're going to be looking at 4 years there. For the Chapter 13, it's from the dismissal date and 2 years from the discharge date. And then for a short sale, it's also a 4-year waiting period as well. Foreclosure for a conventional loan is a 7-year waiting period. There is a weird little caveat in here. If the foreclosure was included in the bankruptcy, you can use the bankruptcy waiting period of 4 years rather than the foreclosure waiting period of 7 years. And if you have any federal tax debt, it needs to be paid prior to closing on the home, or you need to have an improved installment plan, with at least one monthly payment on time. Now, just because you meet these minimum requirements here doesn't mean that you're automatically qualified for a loan. Keep in mind, these are the bare minimum requirements here. And just because you meet these waiting periods, for instance, just because you didn't have a late mortgage payment in the past 12 months, if you had some in the past 24 months, AUS might not approve you for a loan. Now, with collections, medical collections are not required to be paid off regardless of the amount. If you have past due amounts, they need to be brought current. And for charge-offs and collections, it's based on if you're buying a 1-unit home or a 2-unit home, or a second home. So for 1-unit homes, you're not required to pay it off if your loan is underwritten through AUS and it gives an approval. And your loan officer will be able to tell you this. They'll be able to run it through the software and see if you can get an approval without paying off any charge-offs or collections. If you're buying a 2 to 4-unit home or a secondary home, if you have a total of more than $5,000 in collections and charge-offs, then it has to be paid off. So something to keep in mind. Okay, now for student loan rules. Student loans are handled a little bit differently between different types of loans. And the main reason we care about looking at student loans is because student loans are going to impact your debt to income ratio, which changes the maximum loan amount that you're approved for. So this is a real big issue when student loans are paused, because when the loans are deferred, we then have to come up with a monthly payment for the student loans. We can't just enter zero if the student loans are deferred. So Fannie Mae requires your lender to put in 1% of the loan balance as a monthly debt, basically. So that can really lower the amount that you can get approved for. Freddie Mac has that at 0.5%. Now, on both loan types, you can have income-driven repayment. Both programs, Fannie Mae and Freddie Mac, accept IDR. So that's great. So if your student loan payment was $300 a month and on IDR it's $100 a month, your lender can use $100 per month in your debt to income ratio, which is really great. But between these two, only Fannie Mae accepts $0 per month payments. Freddie Mac will not accept $0 per month payments. So if you're on an IDR plan, or for whatever reason your student loan is at $0 per month in repayment, then Freddie Mac's going to require that 0.5%. So it's something to be mindful of depending on your student loan status. So for example, if we have a $30,000 student loan balance in income-driven repayment at $0 per month, Fannie Mae would allow you to use $0 per month. Freddie Mac would require $150 per month. Now, keep in mind, I'm not saying that you have to repay back the loan this way, but the lender is going to enter in $150 per month as a debt, basically. And even though you're not paying that, that's what they have to do to kind of show that you're repaying the obligation. It's a silly rule, but that's just the way it works. So it's good to note the differences between the two. So if you are looking to enroll in income-driven repayment, you can go to winthehouseyoulove.com/student. And on there, I have a calculator in collaboration with LoanSense that can show you the different savings you can get with income-driven repayment. Now, for citizenship, DACA is allowed with Fannie Mae. So if you're a DACA recipient, Fannie Mae is going to be the way that you want to go. And basically, citizenship requirements for non-U.S. citizens would be that you need to be legally present and you need to have a valid employment authorization document. So this would be something like a green card, work visa, etc., to be able to qualify for a conventional loan. Now, with income, mainly what underwriters are looking at is they want to see stability and consistency. So they mainly are looking at the past 2 years to find stable employment. Now, this doesn't mean that you have to have 2 years at one specific job. Often people are like, well, I haven't been here 2 years, so I'm never going to be able to qualify. That's just not the requirement for conventional loans. They just want to look at a 2-year history. It can be with multiple different jobs. It's ideal to be in a similar field if you are changing jobs. So if you're a graphic designer and you worked for 5 different companies over the past 2 years, that's fine. The underwriter just needs to be able to see consistency and income from that work. If you're switching through a bunch of different types of jobs, different fields, then that can be a little bit more challenging, and the underwriter might want more clarification on the current job that you have Maybe you do have like certifications for it, or they might want to see a bit more time or consistency in the new job. In retirement, and schooling counts. So you don't have to be actively employed. For instance, if you get a pension and Social Security and you're retired, that's perfectly fine with a conventional loan. Or if you just graduated, let's say you just graduated college, and then you're immediately going into a field that matches your degree and you have a job offer letter, then the schooling counts for that 2-year history as well. Self-employed people are going to often need a 2-year history to be able to qualify for a mortgage. And then also, if you have non-taxable income, so things like Social Security, the non-taxable portion can be grossed up 25%. Since lenders look at gross income for affordability, and since that portion of your income might be non-taxable, they basically will increase it by 25% to help you qualify for more. Now, a lot of people aren't aware you can actually use your rent history to help you qualify for a conventional loan. So for most people, I wouldn't suggest doing this. You only need this if initially your application for a conventional loan doesn't work. If you're not able to get approved for a conventional loan, then I would only add this to help try to nudge the approval in the direction that we want it to go. So if you can already get approved without this, I would say don't worry about this. You don't add it. It's not going to give you anything extra. It's only to help if you weren't able to get qualified to just, again, nudge your approval in the right direction. So the way this works is you need to have 12 months of on-time rental history. And then what happens is the underwriting software is going to need to look at your bank account history to find regular rent payments. And so basically what you do is you securely give the past 12 months access and a verification of assets software. And then the underwriting software is then going to look for regular rent payments over the past 12 months to be able to, again, put in that positive rental history that could help you qualify for a loan if initially you weren't able to qualify. Now, some property types you can buy with conventional loans. Obviously, single family is the most common. You can also get a condo or a townhome. You can also get new construction. Sometimes people get tripped up by new construction. So basically, there's new construction, and that means where a builder is already building a home, or maybe they're planning on building a home, and you just get to customize some of the features of it. And so basically with new construction is the builder finishes a home, and then you purchase it after they build it. A construction loan would be more of you're financing the construction as it goes. So new construction, you absolutely can purchase with a conventional loan. And then also you can purchase manufactured housing with a minimum of 5% down. Now, accessory dwelling units are things that are really only common in some areas of the US, but the rules are slightly different with Fannie Mae and Freddie Mac here. So for a 1-unit home, Fannie Mae and Freddie Mac both allow it to have 1 accessory dwelling unit. On 2 to 3 units and 4 units, Fannie Mae does not allow accessory dwelling units versus Freddie Mac allows it on a 2 to 3 unit home, but not a 4 unit. So if you are looking at properties with accessory dwelling units, it might be interesting to look at the differences between these two here. Some other requirements is it must have separate features for the kitchen, sleeping bath, and bathroom, or bathing and bathroom. And then it must have its own entrance and exit that's separate from the primary home. Now, for affordability, what lenders are looking at is they're looking at what's called your debt to income ratio. So this is the formula lenders define the maximum loan amount that you can qualify for. Lenders are not your financial advisor, and lenders are not really all that concerned about your ability for the home to be perfectly in your budget and it to be comfortable. That responsibility falls on you. You are the one who gets to choose if you're comfortable with a monthly mortgage payment and if that actually fits in your budget and aligns with the goals that you have long term. Your lender is not your financial advisor. Your lender is going to look at, based on the conventional loan rules and the risk analysis, the maximum loan that they would give you. Okay, so please keep that in mind. Just because you can get approved up to a certain amount doesn't mean you should. Often you'll get approved for way more than is probably comfortable for your budget. Conventional loans often are going to go up to just under 50% debt to income ratio. Now, that means that if you make $5,000 per month in gross income, pre-tax income, half of that would be $2,500 a month. If you had no other debt and you had a really great credit score, you could get approved all the way up to a $2,500 per month mortgage payment. Okay, I know that sounds crazy. Again, just because you can get approved for that doesn't mean that you should. And not all people can be approved this high. Your debt to income ratio is going to be based on the risk profile of your loan. And again, that's set by AUS. And all that data isn't published. It's kind of secret, just like social media algorithms are a little bit of a proprietary thing. AUS is not something that's published. We can often find the maximum of things in the best case scenario, but we don't always know what your specific debt to income ratio is going to be. Also, community property isn't a factor like it is in other loans. In another loan, like an FHA loan, if you're in a community property state, your spouse's debts have to be included into the debt to income ratio, even if they're not on the loan. With conventional loans, that's not a factor. And again, like I mentioned in an earlier slide, you can add on a non-occupant co-borrower to help increase your affordability, but that does increase your down payment to 5%. Often what I see a lot of times with non-occupant co-borrowers is where maybe there's someone who's in their mid to late 20s, or maybe even early, somewhere in the 20s, and maybe they just started work, so they have good employment, but maybe for whatever reason it's a little bit more variable, or it's difficult for them to get approved, or maybe they don't have a lot of credit history, and maybe a parent will be a co-borrower on the loan with them. So even though that person could pay back the loan, they might just need a co-borrower to help increase their affordability and loan limit. Now, if you want to know the math of how lenders put this all together, I have a calculator that does this. It's called the max purchase price calculator. And you go to whenthehouseyoulove.com/max price to explore that. And basically what you do is you just put in your income, you put in your debts, and it's going to run through all the math for you, show you different types of risk that lenders look at, and then show you examples of your monthly payment, your upfront costs, and then different affordability theories, like Dave Ramsey's affordability theory, what he would say you could afford, and different other affordability theories. Now, there are limits to the maximum loan amount that you can get with a conventional loan. And keep in mind, this is the loan limit, not the purchase price limit. So what you can do, for instance, is you can take the loan limit. So let's say I'm taking a loan limit for a single family home, 1 unit, $766,550. If you're doing 3% down on that, you divide that by 0.97 to give us a maximum purchase price of just above $790,000. Okay. So for a 1 unit home, you're going to be looking at $766,550. And for 4 units, it goes all the way up to just slightly above $1.4 million that you can get in a maximum loan limit with conventional loans. Now, there are some areas that go even higher than that. And these are what are called high balance loans. When a loan amount goes above this range, it requires 5% down and does have to be in a certain area. So I'll have a link in the description to the loan limit map. And what you can do in here is you can see, all of these areas are the base loan limit. But if you're looking, of course, somewhere in California, that loan limit's going to go all the way up to just above 1.1 million for a single family home. So something to be mindful of if you're looking in those higher, more expensive areas. So you absolutely can refinance your loan, even if you get a 30-year fixed rate loan. In the beginning, it doesn't mean you hold on to that for 30 years. You don't have to. You can always refinance in that time. So there's a couple different refinance types. So one is what's called a limited cash out. Now, this used to be called a rate and term refinance, and then they changed the language to limited cash out for, just be confusing, I guess. You can do this at any point in time. And basically what happens here, this is really common if, let's say you got a 7% interest rate. Let's say interest rates go down to 5.5%. You can do a rate and term refinance or a limited cash out refinance to then get a lower interest rate by using that refinance. Also, let's say you've had your home for a while and maybe you have quite a bit of equity in the home. Let's say you have $100,000 in equity and you want to pull some of that equity out to maybe pay down some high interest credit card debt. Or maybe you want to do some home improvements. You can do a cash out refinance. And that's basically where your interest rate is going to change to the market rate. But then also you can get cash out of your home, again, to do things like improvements, or maybe you're paying down debt, things like that. You do have to be in your home for at least 6 months to be able to make that work. There's also this little trick called delayed financing that a lot of people don't know about. But basically what happens is, let's say you have a ton of cash and you're looking to buy a $300,000 home. Let's say you have $300,000 in cash. Again, I know that's not most people, but there is this thing you can do with conventional loans where you buy the home in cash. So you pay $300,000 in cash for the home. That helps you, your offer stand out, higher chance of getting that offer accepted. Maybe you can get a slight discount with paying in cash. And then you can actually do a cash out refinance within 6 months to be able to pull out 80% of that cash back that you can then use for whatever else you want. So it's a nice way to get the best of both worlds, a cash offer up front, and also still not have your cash tied up in a home. And this is called delayed financing. Again, most people don't know about it. Most people probably won't use it because it's rare that people have that much cash to play around with. But it's something that does happen with conventional loans. Now, appraisals. What an appraisal is it's a third party that's hired by the lender to verify the value of the home. The appraiser is not a home inspector. The appraiser mainly works for the lender because the lender is going to give you quite a bit of money, and they want to make sure that if you default on your loan, if you don't make your payments back, that they have a high likelihood of being able to sell your home and get their money back. That's the main goal of an appraisal. The main goal of an appraisal is not to help you understand if the home needs a bunch of repairs. That's what a home inspection is going to do. You still need a home inspection even with an appraisal. Now, conventional loans, I talked about in the beginning, sellers like conventional loans, and that's because they're the easiest of most loan types to get through an appraisal. Sometimes FHA loans, for instance, can be a bit of sticklers about different repairs in the home, and sellers don't love that. And so that's why they tend to like conventional loans. And then also they are transferable from another lender. And that's the benefit of working with a team like us, is that we function as a broker. So we work with multiple different lenders. And so if, for instance, you have an appraisal that comes in lower than the value that we want it to come in at, we can actually switch lenders and then be able to get a new appraisal to potentially see if that home can appraise for higher with a different opinion of value. And again, keep in mind, the appraisal protects the lender. It's not mainly there to protect you. In some instances, yes, it can help maybe you not overpay for a home. In my opinion, that's something that your real estate agent should help you with in looking at comparable homes and what you're comfortable paying for. But the appraisal is mainly there to protect the lender. Now, there's a couple different appraisal types, and this is decided by AUS, the underwriting software, the type of appraisal that is allowed to be done. So there's a traditional appraisal. It's what most people are used to. So basically what happens is an appraiser comes out to the property and they're going to inspect the interior and exterior. They're going to come up with a report. And what the core of an appraisal does is they're looking at the home, and then they're looking at comparable homes. So similar square footage, similar baths, similar conditions in a local area that have sold recently. Those comparable homes to justify the value of the home that you're buying. So that's the core of what an appraisal does. There also is what's called an appraisal waiver. And this has been something that a lot of people have kind of been confusing recently. So I'll explain what an appraisal waiver does, and I'll explain here in the next slide how people are messing this up. So it used to be called an appraisal waiver. Now they call it value acceptance. So basically what happens is sometimes the underwriting software will look at data and actually not require an appraisal at all. They'll basically just say, hey, we're fine with your contract price. And they use data models to be able to see if the amount that you're paying for the home is verifiable, that they're comfortable with that type of risk. More and more common is basically an appraisal waiver with what's called a property data report. So they're looking at the value from the contract price. Basically, the underwriting software is saying, hey, we're good with the contract price, but we also just need a little bit more data just to verify that everything is fine. So that's an interior and exterior data collected by a third party. And this is basically to make sure, the home on the inside isn't completely in disrepair. And then there's also a hybrid appraisal that's not as frequent. So the value would be from an appraiser. And basically what happens is an interior and exterior data is collected by a third party and then given to an appraisal. And a lot of these things have come out from COVID and different restrictions from appraisers and trying to limit the amount of people coming into a home. Something to keep in mind is that appraisal waivers or value acceptance is going to be only if you're looking at 20% down or more to be able to get those. Now, there's a big myth going around with appraisal waivers. So there's appraisal waivers and there's appraisal contingency waivers. So right here, an appraisal waiver is when the lender says, we don't require an appraisal for you to buy a home. Now, what a lot of people have been doing in competitive markets is they're saying, yeah, I did an appraisal waiver. I waived my appraisal. And it's not true. They did an appraisal contingency waiver. See, when you're buying a home, most contracts have a clause called an appraisal contingency. And it basically says, I'm willing to buy the house for $300,000 as long as the home appraises for $300,000 or more. If the home appraises for, let's say, $280,000, that contingency gives you an opportunity to exit the contract. So what a lot of people are talking about when you hear appraisal waivers is they're talking about an appraisal contingency waiver. They might have waived their contingency and basically said, hey, if the appraisal comes in short, they're willing to cover the difference in cash. Or maybe they have a gap, a maximum that they're willing to pay. Maybe they'll pay a $10,000 gap, but they won't pay a $30,000 gap if it comes up. So just something to keep in mind when you hear appraisal waiver. Often people are talking about appraisal contingency waivers, which I do not suggest doing. Now let's run through some examples here because we've talked about a lot of guidelines and theoretical things about conventional loans. Let's ground this a little bit. So this is a home I found on Zillow. This is a real home. I looked up real property taxes, real information about this loan or about this home. I'm not going to list it the address here because I don't want to dox anybody. But here's a picture of the home. This is in Phoenix, Arizona. So this is listed for $750,000. Okay. So if you bought the home at the sale price here, you would be looking at just shy of a $6,000 per month payment and about $51,000 in cash to close. Now, if that sounds like a lot to you, that's perfectly fine. I have a lower cost example here. I just wanted to show you on the higher end what this can look like. So in this payment, you have principal and interest, and we're running this at 7.25% interest rate, which is about a national average now. So you also have the private mortgage insurance, property taxes, homeowners insurance, and this home also had an HOA fee of $222 per month. Okay, so all that added up to being just shy of $6,000 per month. Okay, now for the cash to close, I'm assuming this person was looking at, let's say, 5% down, so it'd be $37,500, and closing costs would run them about just shy of $14,000 using some estimates. So I'm assuming they didn't ask for a seller credit because Phoenix is a competitive market. And so this might be a scenario that someone in Phoenix may run into at this price range. Now, again, this may not be you, and you may be looking at something that's a little bit on the lower price range in a less competitive market. So here's another home that I found in North Carolina for $280,000. So the payment here would be $2,200 per month with just shy of $4,000 cash due at closing. So principal and interest payment, again, running that at 7.5 or 7.25%. PMI is about $136 per month. Property taxes of $117. HOI or homeowners insurance is $111, and there's no HOA. So that would give you a $2,200 monthly payment. And also what I did is I ran the grant finder for a buyer who might qualify for this type of loan. And they could qualify for 1% down with a 2% grant. So 1% down would be $2,800. Closing costs for an estimate would be around $6,700. And with the market here not being as competitive as something like Phoenix, a buyer might be able to ask for 2% seller credit, which would give them $5,600. That would bring their total cash to closing to, again, just about $4,000 to be able to purchase that home. So again, I wanted to show you kind of these extreme examples. There's the high end of the range where you have a high monthly payment, high cash to close. It's a competitive market. And then you also have a lower competition market that has a lower cash to close. There was a grant used, and you also have a lower payment. So there's a wide range here with different types of loans. Now, when we're looking at the appraisal, like we were talking about before, appraisals are looking for the condition of the home. They're looking at the value, but they also want to make sure there's not huge issues with a condition. So let's go through some big issues first, and then we'll go through some as-is issues or as-is things. So for instance, some big issues would be active roof leaks, water seepage, significant plumbing leaks, curled missing roof shingles. You want 3 years of life remaining on the roof, damaged or failing foundations, mechanical systems exceeding its expected life or they're non-functional, and then sanitary system with evidence of failure. Some issues that the appraiser might find but are allowed and accepted on a conventional loan might be things like worn floor finishes, minor cracks in windows, minor damage to interior walls, damaged or missing interior doors, missing handrails, damaged countertops, missing hardware, missing light fixtures, damaged or missing trim, minor plumbing leaks that don't cause damage, and deteriorated sidewalks. For instance, on a FHA loan, something like missing handrails would be required to be fixed, where on a conventional loan, they're not required to be fixed here. Now, when you are looking at getting a conventional loan, it's important to keep in mind the seller's mindset, because you want the seller to accept your offer, and the seller is going to know what your loan is. And conventional loans, thankfully, are seen as kind of the standard option. They're seen as a buyer who has good credit and has everything put together, and likely that loan is going to go through. Because sellers are afraid that they're going to accept your offer, and then 20 days down the road, something's going to go wrong with your loan, and they're not going to, they're going to have to go find another buyer. So thankfully, conventional loans are seen as kind of the more competitive option. Of course, cash is going to be the most competitive, and conventional is just right underneath cash as more competitive offers. So it can be more preferable sometimes than cash if the offer is higher. So this can be a little counterintuitive, but if you think about a seller, most sellers are assuming that it's going to take about a month to close on a home. They're expecting that most buyers are going to purchase their home with a loan, and most loans take about 30 days to close. So a seller is already assuming, hey, it's probably going to take 30 days after we accept an offer to get to the closing table. And so if you're up against people who are purchasing with cash, sometimes what can happen is cash buyers often want to use cash and leverage it to get a lower payment or a lower purchase price. So if you're looking at a $300,000 home, if you offer $300,000 on that home, but someone with a cash offer comes in at $290,000, often a seller will choose to go with the conventional loan because they're going to get $10,000 more, and they only had to wait 30 days versus a cash offer might close in 2 weeks. And so kind of is a no-brainer for a seller to, if I wait 2 weeks longer, I can get $10,000 more. So keep that in mind. I know a lot of people feel discouraged by cash, but often if you come in with a competitive offer with conventional, can be more attractive to a seller than just cash. Now, please be careful here because buyers recently have had a tendency to make really risky offers. We've been seeing people who are waiving their home inspection, so they're choosing not to get a home inspection, which I do not recommend. I absolutely think you need to get a home inspection because most people don't know how to inspect a home, foundational issues, or just general repair costs. And I don't want you to purchase a home, move into it, and find 6 months down the road that you need $10,000, $20,000 in repairs that could have been spotted by a home inspection. So people are waiving inspections. We're seeing people do appraisal contingency waivers where they're basically saying if the home appraises at a lower value, they're willing to make up the difference in cash. I wouldn't suggest doing that as well. People are doing some pretty risky things with conventional loans. And I just want to put in a reminder to be grounded in your offer. I know it can be really competitive, but if you're going to put in more risky offers and waive some of these things, really you need to have, the best way to describe it is I would say don't do these risky things unless you have a boatload of cash to play around with. If you have a boatload of cash and you're really comfortable with the income that you have, then if you really want a home, making a risky offer may be something that you want to do, that you need to personally be comfortable with all the risk associated with it. For most people, things like home inspections, appraisal contingencies are there to protect you, and also work with your real estate agent. A lot of people are afraid that they're going to overpay for a home. The way that you make sure that you don't overpay for a home is checking out comparable homes, seeing what other homes have sold for, looking at the long-term price trajectory of certain neighborhoods, not just the nation, not just your state, but different neighborhoods and where you're looking to buy. Work with your real estate agent on finding what's a realistic price to offer for a home, and don't get swept up in the frenzy of everyone overbidding and competing for different homes. Okay, so this is a lot. If you made it to this point, Congratulations. Let me know in the comments if you made it to this point. And it's incredible that you've taken the time to learn more about these different loans and choose which is best for you. The best way to get started now is to go ahead and get pre-qualified with us. Again, winthehouseyoulove.com/lender. Schedule a call with a member of our team, and we'd be happy to help you with a pre-qualification for a conventional loan or any other type of loan you want to look at. And then also, if you want to work with an agent next, you can go to winthehouseyoulove.com/agent to get connected.